In the last video, we looked at sector analysis and how using tools like the SWOT analysis, we can analyze sectors we should be looking at. Today, we're going to take it a step further. We're going to look at companies that we should look at within those sectors. And there's three things I'm going to be covering. We're going to look at the business model that leads to competitive advantage. And we'll look at examples like these. We'll also look at the competency of the management team and how that impacts the share price, both short-term and long-term. And we'll look at how stock price reacts to company earnings and their future outlook. I hope you find this useful. Thanks again for watching. Remember to hit that subscribe button so you don't miss any future content. Check this out. When it comes to picking stocks, you want to pick companies that have a competitive advantage. And the key to that is the business model itself. Companies with good business models will have a competitive advantage, and they're the companies we want to target as traders, as investors. And here are some examples. You've got Apple, Amazon, Nike, and you've got Tesla. And when we talk about competitive advantage, we only have to look at the EV market and use Tesla as an example, which continues to dominate this area. Look at this headline. Tesla sold almost 1/4 of all electric vehicles worldwide in 2020. They claim to have 23% of the entire battery electric car market and 16% of the entire plug-in market, which includes battery electric vehicles. Good competitive companies also don't stand still. Look at this headline. Tesla's sales in China grew more than double. Even though they have a competitive advantage, they're still trying to get bigger, get better, expand in different markets, different areas of the world. That's what a good, solid company does. Here's another example. Let's have a look at Amazon now. So this is a breakdown of an overview of the different parts that make up Amazon, showing each business unit's net sales from June 2019 to 2020. Although online sales or online stores and third-party selling take up much of Amazon's total turnover, the other areas like Amazon Web Services, subscription services, physical stores, and ad revenue, they're also a significant part of the revenue driver. This is really a solid, diversified company. The reason I wanted to highlight this is when picking stocks, it is worth looking at companies which have a diverse range of products. Because if one area is not doing so well, another area might be able to compensate. It's one of the big reasons why Amazon has been a big winner from the pandemic. If we look at the global smartphone market, we can see that Apple has a large chunk of it along with Samsung. I'm focusing on the light grey area where you can see Apple has maintained the market share of low to mid-teens from 2018 right up to Q1 of this year. Drilling down further, you can see here a chart of Apple's revenue by product. Apple has a diverse range of products. You can see the light green area, for example, that's the services business, and that has grown over time, reducing the reliance on the iPhone sales. Similar to Amazon, Apple has done well during the pandemic, and its diverse product range has helped the company remain resilient. So another thing to look at, same theme, looking at companies with diverse portfolios and product ranges. That's the companies we should be targeting. Then we have competency of management. The competency of management does not only influence the future of the company, it can impact the share price, not just in the short term, which creates volatility when new CEOs are announced or incumbent CEOs announce their resignation. It can impact the long-term trajectory of the share price. Here's a couple of examples where there have been management changes. First one here is Disney CEO resigning. Here is a chart of Disney since Bob Iger took charge in 2005. You can see the stock has been in an uptrend. Then there was T-Mobile chief who announced his resignation in 2019. During his run as CEO, T-Mobile's stock went from $12 to nearly $80. So it just gives you an idea of how management can impact the stock price. Sometimes changes to the management team are not always a bad thing. Have a look at this news report, where Wells Fargo CEO announced his resignation. The shares of Wells Fargo shot up This happened at the end of March 2019. Competency of the management team is an important aspect when picking a company to trade or invest in. Let's now move on to company earnings and future outlook. So company earnings are closely watched by shareholders, and the reason the share price reacts to the announcement is because it's a formal communication between the company and its shareholders, letting them know how the company has performed and what's in store for the future. From this, shareholders can decide whether to continue to back the company and hold, or sell the stock. Now, there's usually 3 key pieces of data that traders look for or watch out for. You got earnings per share. So how much did the company earn its shareholders per share? Then you've got the revenue, which is the sales the company has generated during the period. And then you have forward guidance and company outlook. Now, this is usually forecast sales and EPS for at least the next quarter. The key is not so much the absolute number, but the expectation in the market. I'll give you a few examples. Here is an example of Netflix reporting earnings. In this instance, the company beat on both EPS and revenue, but the focus on the streaming service is on subscriber additions, which it missed badly, leading to a sell-off in the stock. Here's another example. With Apple, it's slightly different again because it has various revenue streams, as we've seen. So there's an expectation on each product. As Apple beat not only on EPS and revenue, but individual product targets, the stock rallied on earnings. Then there's forward guidance. Now, forward guidance and outlook also play a factor in the stock price reaction. Here's an example of Intel releasing earnings, beating on both EPS and revenue, but look at how the stock reacted. The reason for this was poor forward guidance, and traders decided to dump the stock. So it's important to take all 3 into account when analyzing and trading these companies during earnings season. So that covers part 1 of this company analysis series. Thanks again for watching. Until next time, take care, folks.